Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, December 20th, 2022. Happy holidays out there, my friends. So, obviously, the big news this morning is the BOJ's revision to its yield curve control program, shocking the world overnight by increasing the band 25 basis points to 0.5% in terms of the upper boundary of that band there. They're still targeting 0%, obviously, as the policy rate, but the band is now widened. And as we've seen a pretty sizable move, 15, 16 basis points or so in 10-year JGB yields. Interestingly, have not gone up to the full upper boundary of the brand. So that is somewhat of an indication that there is demand for sovereign fixed income securities out there at the right price. But again, we're still having a lot of price discovery in global sovereign debt markets. So just in terms of our take on this, very clearly Kuroda's on his way out in April. His term ends in April. Guy's 78 years old. In our opinion, and again, I think there's a lot of opinions out there with respect to what this is signaling. It's our take that Kuroda wants to take a victory lap, given the substantial progress Japan has made on the inflation front. Get headline inflation at 3.8%, 180 basis points above the target. Core inflation, if you look at inflation ex food, fresh food, that number is at 3.6%, 160 basis points above the target. Both of those numbers are roughly 3 sigma moves relative to their respective trailing 10-year mean. So it's very clear that Japan has made a lot of progress on sort of defeating the deflation dragon, if you will, at least on a transitory basis. Again, our models in terms of our grid model projections for Japan, which we discussed in our leadoff morning note this morning, have Japan. The Japanese economy heading in a deepening deflation. That's growth down, inflation down in delta terms, starting in March of next year. So it's unlikely that they're really going to be able to do anything that looks like a significant phase transition in Japanese monetary policy that persists throughout 2023. In terms of Kuroda's successors, so that is the key question here. One of the biggest calls I ever made in my career was sort of getting out in front of the move, the sort of LDP's victory in the fall of 2012. And what that likely signal for BOJ's policy. Short at the end, bought Japanese stocks, and the rest was history from fall of 2012 all the way through kind of, I think, early 2014. I don't see those similar types of dynamics this time around in terms of a big phase transition in Japanese monetary policy relative to the previous regime. If you look at Prime Minister Fumio Kishida's sort of guidance, he's effectively targeting as current deputy governor, BOJ deputy governor Masayoshi Amamiya, and the former deputy governor, I want to say his name is Hiroshi Nakaso, as the two sort of front runners. Amamiya is very much likely to be a continuation of the very ultra easy, very dovish monetary policy that we've seen out of the BOJ in recent years in the Kuroda regime, while Nakaso does likely represent a decent change, given that he's already authored a book about how the BOJ could actually escape its ultra easy monetary regime. So we'll see. We'll see if we get any incremental signals as it relates to which of those two gentlemen is likely to be the next head of the BOJ. It could be someone else, by the way. That's just the current. Those are the current front runners. But again, a lot of volatility being injected in global currency markets. A lot of volatility, obviously, being injected in global fixed income markets. Markets are initially responding to this weakness that we've seen in the dollar, really since Thursday of last week, or really since Friday of last week, rather, as sort of somewhat bullish for asset markets. You're seeing a little bit of lift in crypto markets, seeing a little bit of lift in equity markets. It's not going to be bullish whenever the dollar is going down because the rest of the world central banks are tightening more than the Fed is tightening. That does not lead to positive outcomes. So ultimately, we think the algos are going to have to figure that out the hard way in the coming weeks and months. Anyway, transitioning to my longbow dashboard with our global macro overview here. So Bloomberg Dollar Index, that has been bearish on both the short and medium term price momentum basis, right in the middle of the probable range there, the trading range there. Gold also in the middle of the range, bullish on both the short and medium term momentum basis. 10-year treasury yield, that's bearish on both durations, getting up towards the upper boundary of the trading range there. You're now starting to see some weakness, some more interest rate volatility being pushed into global sovereign debt markets. I mean, it makes a lot of sense, right? You got the ECB going full ham, Bank of England going less than full ham, maybe slice of ham. Obviously, the Fed increasingly going full ham, and now you have the BOJ, with at least a move to widen that band, which are obviously is injected a little bit more volatility in global fixed income markets. Maybe have we seen the highs in long-term bond yields? Perhaps we've seen the highs, but do you want to buy them today at 360 something on the 10-year? Maybe we get back to 4 in the coming weeks and months, just given where we are in this phase one liquidity cycle downturn, i.e., it is not done. S&P 500 neutral on both durations, again towards the lower boundary of the trading range. VIX neutral short term, bearish medium term, right in the middle of the range. NASDAQ neutral on both durations towards the lower boundary of the range. Russell 2000 bearish short term, neutral medium term towards the middle of the range. Bitcoin neutral short term, bearish medium term, middle of the range. Same deal with Ethereum. Shanghai Composite neutral on both durations. Finally getting an oversold signal in China. But again, look, it's breaking down, really pushing that the lower boundary of that trading range, the longbow trading range here in a very significant manner. And as we talk about, again, we have volatility regime switching as a core feature of your trading range process. It's usually a leading indicator. These sort of the breakdown, the persistent violation, if you will, of the upper or lower boundary of a trading range is generally a leading indicator for a phase transition in the price momentum. So I'd be very concerned about that. If you're long assets playing for a Chinese recovery theme, we talked about that in our most recent Around the Horn as well in great detail in terms of the outlook for Chinese growth, both over short and medium term perspective. So to go check that out from last Saturday. And then lastly, crude oil bearish on both durations, right in the middle of the trading range there. And then checking my free daily alpha tab, we got about 3,300 ETFs in here, all representing individual factor exposures. Try sorting by the odds column to give you a sense of what's most overbought, most oversold. Nothing particularly overbought this morning. What's most oversold? Again, the oversold signal in China industrials, very similar signal that we saw in the Shanghai Composite. Not quite as a negative signal. You're not really probing the lower boundary of the range there. So if you're buying any China to participate into 2023 Chinese recovery, that again we believe will be delayed relative to current expectations, you definitely want to be thinking about Chinese industrials as opposed to the broader Chinese industries in indices. And then anything else signaling particularly oversold for you dip buyers out there? Chinese utilities, also similar signal there. Very thin trading range there, so I wouldn't trust that signal as much as I would trust the other one. And then lastly, anything else out here? I'm trying to get you guys paid. It's the holiday season. I'm a Chris Kringle. I'm not here trying to get you paid. This is a free program where you get to get some of the world's top trading signal. I mean, I keep getting fantastic reviews from Twitter, et cetera, about this program. And if you look at the YouTube comments, it's like, man, I can't believe this is free. Again, we just appreciate the opportunity to embellish the process, with the large and global audience. It's been a great learning journey of 2022. A lot of investors have learned a lot from this program in particular for free. So we appreciate you guys tuning in to that. And then nothing really particularly to call out. Ethereum's kind of sticking out there, but again, wouldn't be reaching too far into my pockets to be buying a lot of digital asset exposure, given the regulatory headwinds see coming down the pike, given the fact that we're still in phase one of the liquidity cycle downturn, and also, which is going to be a hot take. I know a lot of investors think differently about this, but given that we have not even begun to price in phase two of the bear market, which is the credit cycle downturn. A lot of folks think just because the S&P went down 27, 28% peak to trough that we already priced in a recession. And I say, no way. Go look at slide 66 from our macro scouting report and all the slides after that to get a clear indication that we have not priced in a recession, and that remains ahead of us as we go into 2023. So happy holidays. Catch you back here tomorrow.